want to talk a little bit about annuities. Annuities are or annuities for lifetime income. Annuities are good for, in many cases, depending on the company, not running out of money. So if you put a lump sum of money in there and turn on the income, you'll get a certain amount for years to come, and it can even have a cost of living increase. And you can as well have a death benefit along with it. Again, depends on the company, depends on the product, but it's a good way of not running out of money. They also have the options for fixed interest. You can either get a fixed interest rate, usually a little smaller, or you can do what's called an indexed rate. An indexed rate it's not, your money's not actually in the market, but it mirrors a market index. So it could be the S&P that it follows. There's several others, again, depends on the company. They have different indexes that they utilize. And those, the good thing is they have a downside protection with that, meaning that you won't take any less than a zero, you won't take a loss. And on the flip side, if it goes way down, you won't take that loss. You may not make anything, but you won't take the loss. So you have downside protection, which if you lose the money, it takes quite a bit of time to get the money back because you have sequence of returns. And, you know, if you have, say, $100,000 and you lose 50%, so now you have $50,000. But all of a sudden you gain 50%. Well, most people would say, oh, I have my $100,000 back. Well, no, you don't, because you got $75,000 because it's 50% of 50. So you made $25,000 in that instance back of your money, but you did not go back up to your original 100. And it will take a period of time to get back up there. And could that happen at the worst time? Could you be in retirement? Could you be taking income? There's things to consider. So when people say average return, well, is it average actual return? Because, you know, saying, oh, well, it went back up 50%. Well, that's not equal. So those are things to consider. But the flip side is that this doesn't have, since it has a downside of zero, meaning you won't make any gain for the year, but you also won't lose your principal. The following year, wherever that bottomed out at, you will end up, in some of them, it's not necessarily on a yearly basis. It depends on the indexing strategy again, but sometimes it's month to month, every 2 months, you know, there can be different time frames, but you know, if it's yearly, let's just say it's yearly. In some cases, they are yearly. So let's just say it's yearly. If it was down overall for the year, well, you start at that down point and you go up from there. So if there's a 20% increase in the market from that very down market, maybe it never gets to where, or doesn't get to where it was previously because it was way up, you still made 20% on your money that year. So, and maybe I explained that bad, but in general, you will have a gain starting from the low point. So that's the nice part of that. So whenever you start having these things for years and years, you're not going to lose your principal. On top of, you can only stand to gain for the most part, and you ideally have an annuity that has very little expenses or no expenses at all, and you're able to utilize that income. And many times those income, what's called an income rider, many times whenever you turn on the income, it will have a cost of living increase or a certain amount of increase per year as it, you know, as you age. And then the nice thing is if it ever ran out of money, say you outlive the expectation and it runs out of money, most annuities, not all, but most, will continue to pay you. They'll continue to pay you with those increases and those different things. Those in those scenarios, I should say, not different things. In those scenarios, it will continue to pay you. So you're not having to do without that income, and it continues to pay you. Now, if you should die prematurely, depending on the company, depending on the actual product, but there are annuities, and a lot of them have it now, where you have a death benefit. So some have a death benefit as long as there's still $1 in the account. You get basically the full amount of what it originally was. The original amount that was put in, not with the growth. But there's variations, and there's different, everybody has their different guidelines for different things, but it is a great tool. The difference in this and in the life products is one, the life products, if you're doing it right, you're not having to pay taxes on the money as far as your retirement is concerned. In this case, you only pay taxes on the gains. So, and then they utilize a formula to of how much of that is, whenever you pull out your withdrawals, that is your gains, and then so much is considered principal. So you're not paying taxes on all of the money you're pulling out. You're just paying taxes on gains. They just don't allow you to take out just gains, or just, well, they might allow you to take out. It still abides by the formula either way, but they consider part of that return of principal, or return of your original money you put in, so they don't tax you on that. Unless it was a situation where you rolled over like a 401k or something, which a lot of people will, because in retirement, you want safe money. You want that money to be safe. You want that money to be protected. And in many states, not all, but many states, annuities protect you from creditors, IRS, whatever it is, from potentially bad situations, being sued, whatever the case may be. It helps protect the legacy of your money. So, and I say legacy because there's a death benefit if something happens to you prematurely. The old annuities of the old times, and there still might be some out there, I'm not familiar with any of them, but that where you put your money in there, and if you die early, the insurance company gets to keep your money. It's just like long-term care, which a lot of these annuities can also be, the annuities can also be a hybrid product. For example, you can do long-term care with them. And a lot of times those long-term care ones will have like a multiplier. So they might automatically from day one give you 2 times the money or 3 times the money, depending on the company. And there's different situations. And then the long-term care is a little different, but you can do that with that. You can even do some of these things with certain life insurance companies. They're hybrid products again. There's ones where you can add long-term care riders, income riders, different things. And you really don't have to do it with life insurance, because life insurance, if it's whole life and it's structured properly and gets the right amount of the money, the cash value continues to grow. There's ways of just turning that into income. And, typically you take out there, you're withdrawing your money up to whatever amount of money that you've put in there over the years. And then after that, they're done as loans. And depending on the insurance company, many of them give you a reduced rate at, say, age 60 or 65 or whatever it is. For example, one company gives you at the 20-year mark of your policy, or 60, whichever comes first, they drop your interest rate down to 3%. So it all depends on the product, all depends on the company. But going back to what this is about annuities and safe money, protecting your money. I highly recommend them for people who are looking for assurances, right? They're looking and they're not really risk averse. I mean, there's I guess there's a little bit with indexing, but there's a lot less risk with it because no one can touch your money. Nobody can take it from you. You can have guaranteed lifetime income. So you have guarantees, exactly what you're insuring your retirement, basically. It's an insurance policy on your retirement, for lack of a better word of putting it. Please like, subscribe, and click the notification bell. Again, if there's ever anything, any questions, anything like that, put in the comments. I will try to either make content on it or I will respond. And I'm always happy. I have my calendar link down below. Go to my calendar link, schedule a session, even if it's just a shorter 15 or 30-minute session. You have some questions, I'm happy to answer your questions. Have a great day.